How does a company you've never even heard of surpass Microsoft's market cap just a decade after going public? I bet you probably still don't even know what it is that they do. I'm not talking about Nvidia. I'm not talking about Google. I'm not talking about Amazon. I am talking about Cisco.
Who?
That's right, Cisco. They're not just these cheap routers that you used to find at Radio Shack. Do you remember this sound? That's Cisco. What's Cisco's story, and why should we as investors care? Let's find out. We looked through 5,000 stocks over 45 years to find the best ones, so we could study them to answer the burning question, why? And with Cisco, why has Cisco's stock done so well? From October 19th, 1990 to October 13th, 2000, Cisco's stock returned, ready? 55,960%. Crazy. So how did they do it? Let's start from the beginning. Cisco perfectly positioned itself as the backbone of the rapidly growing internet. The internet as we know it officially began on January 1st, 1983, as the Defense Data Network transitioned to the TCP/IP standard.
Shall we play a game?
In English, the TCP/IP standard is like the language computers use to communicate over the internet. It ensures the data sent from one computer to another is done correctly. The big explosion in the internet began in 1989 as Tim Berners-Lee created the World Wide Web, or WWW. This revolutionized the internet and allowed the creation of websites utilizing graphics, audio, and hyperlinks. The internet we know and love today began in the early 1990s when Cisco entered the story. What's the story? Here's the story. Cisco was founded in 1984 by two Stanford University computer scientists who had connected the school computers over a network. They had pioneered the concept of the local LAN network, or LAN. This protocol allowed computers to connect at a distance over a router system. In English, it allowed them to communicate with each other over long distances on the network. In the early days of the internet, LAN and routers played a crucial role, enabling communication and resource sharing between networks, serving as a bridge between different computer systems. An easy way to think of that is Cisco routers acted like the traffic cops for the internet. To say this was groundbreaking is completely underselling it. Cisco's routers played a pivotal role in shaping the modern internet backbone and networking landscape as we know it today. Their innovation, scalability, and capacity helped support many different services, leading to their incredible popularity and usage. All of this allowed Cisco to become the backbone of the internet, and in large part led to their initial success. In his 2007 book, The Halo Effect, Phil Rosenzweig hailed Cisco as the king of the internet. So can we attribute Cisco's success to the best hardware? Yes and no. They certainly had the best tech, but there is more to the story. Let's dig deeper. Alright, why was Cisco so successful before the dot-com bust? Well, much of it was being at the right place at the right time. During the 1990s, the internet boomed, and as the backbone of that boom, Cisco benefited. So let's put this into perspective. First, Cisco was founded at Stanford in 1984. They went public in 1990. By 2000, they were the largest company in the world by market cap. They surpassed Microsoft with a market cap of $500 billion, all in 16 years. What was the key to this incredible rise? Was it a superior product, or was it something else? As we discussed earlier, the tech was great and enabled growth with the explosion of the internet. But Cisco was also the right company at the right time. With the invention of the World Wide Web, the use of websites exploded. Consider this information from Pew Research. In a 1983 poll, 10% of Americans said they had a home computer. But by 1990, 42% of Americans had a PC, either at work or at home. And they also, Pew Research that is, surveyed people about their knowledge of the internet. In 1995, only 14% of them were aware of the internet, most of those people using dial-up. Another 42% completely unaware, and 21% had just vague knowledge. But of the people who did have access, that valuable 14%, 63% of those people said they would miss the internet if it was gone. Fast forward to 2014, computer usage had grown from 42% to 81%, and PC sales grew from 21 million in 1989 to 93 million in 1998, which is an annual growth rate of 18% annually. That's pretty nice. So, if we combine the growth in PCs both at home and at work with the explosion of the internet, we get a powerful cocktail of demand, and Cisco was there to fill that need. So how did Cisco keep up with the demand and stay at the edge of tech? Cisco was at the forefront of the internet boom, but how did they stay there? From 1990 to 2000, Cisco executed an aggressive M&A strategy, acquiring 58 companies during this time. These acquisitions helped Cisco stay ahead of the competition and develop new products during the PC and internet boom. Many of the acquisitions focused on LAN, switching, or routers, which were critical to Cisco's success. These acquisitions also helped Cisco grow revenues during the 1990s, and grow they did. Remember, Cisco went public in 1990. Annual revenues at the time were $70 million. By the end of 2000, revenues were $18.9 billion. To put that into perspective, million, billion, whatever, right? That's an annual growth rate of 75% over 10 years. That's kind of good.
That'll do, pig. That'll do.
According to Cisco's 1995 10K, the company started entering new markets and broadening their product offerings through a series of acquisitions. Cisco felt they could use these acquisitions to fill gaps in their offerings and give their customers what they needed. This would prove to be an ongoing strategy for Cisco during the 90s and beyond. So, if an acquisition strategy is so powerful, why don't all companies use it? Well, as with everything in finance, it depends. Acquisitions have a good side and a dark side. Let's look at the good first. Cisco's acquisitions during the 1990s allowed it to solidify its position as a leader in networking and internet technologies. By integrating smaller companies, Cisco achieved what we call economies of scale, streamlining operations and strengthening their supply chain. This M&A strategy also gave Cisco what we call a first mover advantage in the growing internet era, which positioned them as the leader in their industry. Ultimately, the acquisition significantly boosted Cisco's revenue growth, helping it become one of the most valuable tech companies in the world. Now for the dark side.
If you only knew the power of the dark side.
Mergers can create difficulties in aligning cultures, systems, and operations, often leading to inefficiencies. A company's pace of acquisitions can risk overextending management, overextending resources, tying up capital which could be used somewhere else, like, I don't know, to grow the company. Next, the costs associated with acquisitions can lead to lower returns than expected. And believe it or not, it's actually a pretty frequent issue. Management underestimates how well they can integrate acquisitions. Plus, the price paid for acquisitions can set back returns for many years, if they're even achieved at all. For reference, McKinsey reports that the failure rate of acquisitions sits around 70%. Bottom line, when all done well, as Cisco has done, acquisitions can be a great strategy. But when done poorly, they destroy capital and shareholder value. So, the next big question related to Cisco is what happened? Why did their stock quickly crash and burn? During the 1990s, Cisco was the guy. They were the stock. As we've established, Cisco brought the magic of the internet to the masses through their switches and their routers. If it happened online during the 90s, Cisco had their hands in it. The company delivered 100% annually from the 1990s, going from a split adjusted price of 80 cents to a height of $79 per share. 100% annually is the same as a stock doubling every year. Absolutely insane. To say the public was bullish on the internet and Cisco is a complete understatement. At the height of the dot-com bubble, Cisco was trading for 266 times earnings. Those are nosebleed numbers, kid. It's an insane valuation for any company, let alone the largest market cap in the world. It proves one super key point: the price we pay matters. In fact, Jeremy Siegel, author of Stocks for the Long Run, stated, "History has shown that whenever companies, no matter how great, get priced above 50 to 60 times earnings, buyer beware." Cisco was at 266 times earnings at the height of the dot-com bubble. When it popped, the stock had nowhere to go but down. From late March 2000 to 2002, Cisco dropped from around $79 to $9.50 a share. That's a drop of 88%. Really, really bad. In fact, Cisco has still not recovered since this time. Its market cap is still below its 90s high. This despite the company growing revenues from almost $19 billion in 2000 to over $54 billion in 2024. Cisco spent most of the next few decades trading in the $15 to $30 range. It has climbed over $60 as of today, but like I said, they still haven't reached that previous peak. I hope this points out the importance of valuation and paying a fair price for any company. Despite the proclamations of "it's different this time," it never is. Market euphoria can be an expensive teacher for the final lesson we all need to keep in mind. The price we pay matters. Cisco is the perfect example of a moonshot, going from founding to IPO in 6 years, and then the largest market cap in the world 10 short years later. To say the growth was amazing is a complete understatement. So what can we learn from Cisco? First, look for companies working in their fields cutting edge and creating products or services that solve a deep need. Cisco wasn't a disruptor like Tesla, for example, but it certainly met a need during a time of great demand. Today's AI might offer the same kind of opportunity. Many people wonder if NVIDIA could imitate Cisco's rise and fall. Time will tell. Next, we need to identify markets that are looking to expand rapidly. AI again comes to mind, but in the past it was industries like commodities, railroads, cell phones. You get the picture. The final lesson, you guessed it, the price we pay matters. Warren Buffett said it best. I'm going to paraphrase here. Find great companies you can understand, with long growth runways, run by people you trust, and for a fair price. If you enjoyed today's video, check out Value Spotlight, where we learn how to uncover great investments for a fair price.